You've definitely heard the term activist investor tossed around in the news, right? It usually pops up when some big company is suddenly in the middle of a major shakeup. But what does that actually mean? Well, today we're going to pull back the curtain and break down exactly what these investors do, and more importantly, how they do it. Okay, so to really get a handle on an activist investor, let's first think about the investor you're probably most familiar with, the passive investor. This is someone who buys a stock, sits back, and just hopes it goes up over time. It's totally hands-off. The activist investor, they are the absolute complete opposite. They buy into a company for the sole purpose of getting their hands dirty and actively forcing changes they think will make that company way more valuable. So let's nail down a more formal definition. An activist investor isn't trying to buy the entire company, not even close. Instead, they buy what's called a significant minority stake. We're talking enough shares to get them noticed and give them some leverage. And they do this with one very clear goal: to get in there and directly influence how the business is run, from top to bottom.
So what kind of companies are they targeting? You can think of activists as hunters, and what they're hunting for is hidden value. They are constantly scanning the market, looking for businesses that they believe are seriously underperforming, companies that just aren't living up to their full potential.
And this right here, this is what a prime target looks like to an activist. They might see a company with a management team that's making some questionable decisions, or operations that are just clunky and wasteful. Or maybe they spot some really valuable assets, like real estate or a brand, that are just sitting there, not being used to their full potential. They look at all this and they don't see a sinking ship. They see a huge opportunity to jump in, fix things, and unlock a ton of value.
And that really is the million-dollar question, isn't it? I mean, they don't own the company. How can one shareholder, who might only own 5 or 10% of the stock, actually walk in and force the leadership of a giant corporation to listen to them? Well, it turns out they have a very, very effective playbook. Let's dive into the how. These investors have a powerful set of strategies they use to punch way above their weight class, giving them influence that goes far beyond what their share count would suggest. And it usually boils down to these 3 core strategies. First, they try to get a seat at the big table. Second, if that doesn't work, they take their fight public to win over other shareholders. And third, they propose very specific, concrete changes they believe will send the stock price soaring. Let's break each of those down. Okay, tactic number 1. The most direct way to force change is, of course, from the inside. If an activist can get themselves or one of their allies elected to the company's board of directors, they suddenly have a powerful voice. And more importantly, they get a vote on every single major decision the company makes. But how do they actually get that seat? They do it with something called a proxy fight. And this is fascinating stuff. Seriously, think of it like a political election for a corporate board. The activist investor launches a full-blown campaign to convince all the other shareholders, from big institutions to small retail investors, that their candidate for the board is a much better choice than whoever current management picked. It is a direct battle for votes. Now, to support that effort, or if getting a board seat is looking tough, activists take the fight public. And these people are often masters of PR. They will release these incredibly detailed presentations or write scathing open letters to the board, laying out all of their arguments for the entire world to see. This puts an immense amount of pressure on management and is a super effective way to get other investors on their side. So all this pressure, all these campaigns, what's the actual endgame? Well, it all comes down to one thing: pushing for very specific changes that the activist is convinced will increase the company's value, which in turn boosts its stock price. And the changes they push for usually fall into one of 3 big buckets. First, you have major strategic moves, like telling the company to sell off a division that isn't doing well. Then there are financial changes, like using the company's cash to buy back its own stock, which makes the remaining shares more valuable. And finally, there are operational improvements, basically finding ways to cut costs and just make the business run a whole lot smarter. So when you put all of these pieces together, you've got the threat of a proxy fight, you've got the very public and often aggressive campaign, and you've got these detailed proposals for change, you really start to see how this all centers on one thing: creating overwhelming pressure. And here's the real kicker. This is what's so powerful about their strategy. A lot of the time, the activist doesn't even have to go through a long, expensive proxy fight. Just the threat of one, the mere possibility of a messy public battle, is often more than enough to bring a reluctant management team to the negotiating table. Which, of course, leaves us with the big, lingering question at the heart of this entire topic. Are these investors a necessary evil, maybe even a force for good, holding bad management accountable and creating value for everyone? Or are they just disruptive outsiders, focused on making a quick buck at the expense of a company's long-term health? That's the debate, and it's one that continues to shape the entire corporate world.